FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Today's show is brought to you by U.S. Gold Corp. U.S. Gold Corp is a U.S.-focused gold exploration and development company advancing high-potential projects in Wyoming and Nevada. U.S. Gold Corp has consolidated a district on Nevada's productive Cortex Trend and is advancing the Copper King project towards production in Wyoming, led by a team of prolific company builders and renowned explorers, including Dave Mathewson, who is directly responsible for several major Nevada gold discoveries. U.S. Gold Corp is well-capitalized and has an extremely tight share structure with less than 20 million shares outstanding and trades on the NASDAQ, a major exchange, under the ticker symbol USAU. To learn more, go to usgoldcorp.gold. That's usgoldcorp.gold.
The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 4/3/19. March is behind us, and we have May to look forward to. Nicer weather for sure, although in Florida it gets very hot. But do you ever feel like you're in the rat race, you're on a treadmill, and as you do your treadmill, the faster you speed it up, the higher the headwind gets. And you're kind of on the financial treadmill, and there's a headwind coming at you, and you just can't go as fast as you want to. You can't be as productive as you want. Well, I've got somebody on you're definitely going to want to hear from. He is a self-proclaimed abundance advocate. We can all use one of those for sure. Hey, if you've got questions for the abundance advocate or for myself, feel free to email us, kl@kerrylutz.com. So got Jim Oliver here. You can find his site at createtailwind.com as opposed to flying into headwind. And Jim, it's really good to have you on. So when I am trying to build abundance, where do these headwinds come from?
They come from financial institutions like banks, Kerry. And what happens is the average American is paying 34.5 cents of every net dollar that they earn to interest. Now, your audience is saying, I'm not paying 34.5% interest rate. But it's not the rate, Kerry, that matters. It's the volume of interest. How much of every payment that you're paying for your mortgage, for your vehicles, for other things that you're financing, your equipment if you're a business owner or a farmer, how much of that payment is interest and how much is principal? That's called the volume of interest. Mm-hmm. And can I give you an example? So Please. Let's say a $300,000 mortgage. Now, we kind of all know that a $300,000 mortgage at 5% for 30 years, we're going to pay about double that. We're going to pay about $600,000 for that house. Oh, if we made every payment for 30 years. Mm-hmm. So let me ask you a question, Kerry. If you earn $1 and you got to give me half, does your interest rate really matter?
It's what you're left with, of course, right?
It's what you're left with. It's you earned $1 and you got to give Jim half. And if I were you, that wouldn't make me very happy. But if I could show you a way to recapture that half and how to pay yourself or a money pool that you controlled, you put all that interest back in there and you recapture that interest. Would you want to know how to do that?
That's a little bit of a leading question. Only an idiot wouldn't want to know, right?
Absolutely. Absolutely.
But I love where you're getting to here. I kind of feel it. So what you're saying effectively is there's a better way of doing these things. You need to look outside the box.
That's right. You cannot be in the rat race. You have to break away from the rat race. Just like you said in the beginning, is you have to understand what the problem is. The problem is that your need for finance over your lifetime is much greater than your need for investment. And Kerry, I live part of the time in Florida and part of the time in the Midwest. And in the Midwest, we're taught to pay cash for everything.
Sure.
But that paying cash creates lost opportunity cost, because when I pay cash for that car or that equipment, that money is gone forever. It will never earn me another dollar.
Mm-hmm.
And Robert Kiyosaki says, make your money work for you, not you go work for money.
Right.
Well, if we're going to do that, then we can't have lost opportunity costs. We can't expend that money and it be gone forever, because now its potential is gone. And so you really, as our great friend Nelson Nash used to say, is he would say, you finance everything you buy. You either give up interest that you could have earned, or you pay interest to some other entity. There's no exceptions.
Mm-hmm. So either way you're financing it, there's implied or imputed interest, or there's actual interest that you actually pay. Do I have that right?
Absolutely. Yes. You're giving it up or you're paying it. And regardless, somebody's making a nice living from you when you go finance your cars. You go finance your house. You finance your equipment. Somebody's making a nice living, and it's the volume of interest that they're concerned with. And then as you make payments back to that bank, what do they do with your payments? They loan it out again.
Loan it out again. It's daisy chained and on and on and on and on. And the beat goes on, as they say, right? As Sonny and Cher would say, right?
That's right. I remember that song. Absolutely. And what we call that in economics is creating velocity with money.
Right.
Now, even if you don't know what that means, it sounds good, doesn't it? Create velocity. You want your money moving fast, because motion is a law of God. If blood doesn't flow in and out of or through our bodies, not out, hopefully just through. If air doesn't move in and out of our bodies, we die.
Correct.
Water becomes stagnant if it doesn't flow, and so does money. Money needs movement.
Okay. All right. So I got the basic theory. So what's next? How do you bring this about? Okay.
So what you do is you have to build a money pool that has a lot of the same attributes that a deposit at a bank would have. Well, it could be collateralized. It could be leveraged. So, if I wanted to use money to go invest in real estate or go invest in a business, then would I rather use my money or somebody else's money to invest in that business?
Yeah.
Somebody else's money, right?
OPM.
Other people's money.
Yeah. Hey, of
That's
course. Right.
Yeah, absolutely. The bank does, right? So if you think about, I'm advocating that you act like a bank. So let's think about that transaction that most people do with banks is you go down to the bank and you make a deposit. Now, when you deposit money at the bank, is that an asset or a liability for the bank?
Oh, for the bank, in theory, it's a liability to the bank.
Boom. You're right, Kerry. Now, by the way, 90% of people don't get that question right. So you obviously know a lot more about money than 99% of the people. So what does the bank do with that money to make it an asset?
Well, they loan it out, and then the interest that comes in becomes an asset of the bank. Earnings.
That's right. The loan is the asset. If you and I owned a bank, all we would be looking at is our loan portfolio and how it's performing, meaning how are people paying us back? What are the interests that we're getting in every month? And then how are we redeploying that, and how fast can we do it? Right? So the bank then pays, or the borrower pays the bank interest, and then the bank pays us interest. Now I'm going to give you a real life example. Bank of America.
Sure.
Bank of America, when you look at their Bauer financial report, which is a report that they analyze every bank in the United States, they had $860 billion of interest-bearing deposits. They paid us, so that's their interest expense, $1.9 billion.
Right.
Harry, their interest income, what we paid them, $44.8 billion.
I like
so when we do
numbers.
the math of that, they're paying us 0.2%, and we're paying them 5.2%.
Right.
So how much better is the bank doing than us?
About 40 times. Yeah, right. Yep, I get it.
Now, do you want to learn how to do that?
Yeah,
I do.
Sounds like a great business.
That's right. So we are our first customer because we're going to buy things. And if we're a business owner, we're going to buy things for our business.
Right.
And then if we could buy things like cash flow assets and then have somebody else pay. We could have somebody else build our bank.
Yeah.
Right? Their money,
right.
Not ours.
But you're still going to have to. Right. Okay.
That's what we show people how to do.
All right. But you're still going to have to use a bank to keep your money, and you're not going to keep it all in your mattress, right?
Right. Now, Kerry, that's not banking. That's bookkeeping. Your checking account is bookkeeping.
Okay. Well.
And it's okay. Use the bank as your bookkeeper. I'm cool with that. I do that.
All right.
But your real banker, where you're financing your purchases and financing growth in your business and everything else, you take over that piece of it and you control it.
Right.
Because we like to say whoever controls the money makes the money, right?
Very true. Very true. There's a lot of truth to that. So how do you do this now?
Okay. So what we do is we show you how to build your own money pool. And then we show you the function of using the money. And basically what we're going to do is we're going to put this money in a very specific type of insurance contract. Now, this is not like a Northwestern Mutual, New York Life, whole life policy like that. Right. This is the type of insurance contract that a bank uses, that a corporation uses. And the reason we want it in this insurance contract is because of the way that insurance loans work. When you borrow money from this type of policy, your money doesn't leave your account. It stays in that tax shelter, growing uninterrupted, and you get to use the insurance company's money. They're going to charge you interest only, okay, which any real estate investor in the audience knows that's the best loan I can get because I'm in control of the principal if I want to pay principal, and then you go put it in motion and make money with it.
Right.
While your money sits in this tax shelter and grows uninterrupted.
Gotcha. All right.
Sounds intriguing, right?
I like it, but not all insurance contracts are created equal, are they?
No. This is a low commission, high cash value contract. Most insurance agents don't sell this because it's a lower commission and they don't like that.
Yeah. So you're talking what you call low load or no load insurance, right?
What it is it's back in the 80s. There used to be something, Kerry. Remember when they had single pay life insurance? And between like 1980 and 1988, stockbrokers were selling this stuff like it was going out of style. Yeah, I remember it quite well. And then the government came in and they changed. They had three laws that limited and eliminated some of those opportunities. 84, 86, and finally in 88, they created this thing called a modified endowment contract, which means if there's nothing at risk, it's not life insurance and it doesn't get the tax benefits. But there's that MEC line that's short for the modified endowment contract, and we can combine a rider, which is a paid up additions rider, where you put in $1 and you have $1 of cash. Now, here's why you've never heard of this from an insurance agent. You put in $1, you have $1 of cash. So what's your cost? Zero, right?
Right. Yeah, you're not paying anything.
So what do you think they pay the insurance agent commission on that? Not much, right?
Nothing, right? Well, they get some kind of residual because you have to pay for the initial policy.
Yeah, they get something small, but that's just because the company's going to hold their money for a long time. Right. Okay. And then you combine that with an insurance contract, that rider with the insurance contract, and you can get for lack of a better term, a turbocharged insurance contract that then becomes a bank or a money pool in a tax shelter, and it has an ancillary benefit of death benefit and long-term care and tax-free buildup and all those things. Okay. Yeah. But it's a money pool, and we can collateralize it at 100% guaranteed contractual.
Yeah. All right.
Pretty cool, right?
Yeah,
now I get to go use the insurance company's money.
Yeah. Well, I mean, it's your money that you put in there. It's not just the insurance company's money, though, right?
Right, but what I mean is my money is going to grow just like it would normally grow inside that insurance contract, tax-free, right? Potentially tax-free as long as I don't let the insurance contract lapse or anything. Yeah. And because I have that cash, the insurance company will put a lien on my cash, meaning I can't take it and run, but it still stays in there and grows. Right. And they'll give me some of their money to go build my wealth with it while my money is in there. And now they're going to charge me interest.
Yeah, but interest you pay to yourself, right?
That's right. So I'm going to be able to build my wealth with OPM, other people's money. That's what we want to do.
Right. All right. It sounds interesting. And so what kind of, so there's a load like for all of these policies, right? Which is customer acquisition costs, and and that includes the commission to the agent if there is one, right?
Yep. And there's no free lunch in insurance.
Yeah.
I mean, and Gary, but we're getting all this money in a tax shelter. So in the beginning, you're going to be behind, but by year 3 and beyond, you're going to catch up, and then you're going to be way ahead. And the money, the cash flow through the insurance contract actually starts to leverage in year 4 or 5.
Yeah.
And what I mean by that is every dollar that I put in, I have more than a dollar to use to go build my wealth.
All right. So how fast?
That's available from the insurance company.
But they're giving you like a 5% interest rate or something, correct?
And then they're giving you interest, right? They're in the form of a dividend. And we want to use mutual insurance companies because we want when you buy a policy from a mutual insurance company, you become a part owner in that insurance company, and the insurance company is required by law to distribute the profits to the owners, which you're one of, in the form of a dividend. The dividend isn't taxable because we're going to keep it inside the insurance contract and buy additional paid-up additions or one-pay insurance policies with our dividend. That has no cost. You put in $1, you have $1 available.
Yeah.
So you just keep doing that.
Right.
Keep doing that inside the tax shelter until someday you say, hey, you know what? I want to distribute this money out of this insurance contract. And guess what rate we pay in tax when we do that?
None, right?
0.
Yeah.
That's right. If you do it right, which, we would show you how to do that.
Sure. Okay. Interesting. An interesting premise. So there's these obscure insurance contracts that are still left over from bygone years that most people don't really know about and most agents do not push. And basically what you're saying is, hey, we've got the inside track on this, right?
Absolutely. What we specialize, what Create Tailwind does is we try to work with business owners, affluent individuals, people that are looking for financial freedom, not people that are building retirement accounts and then they want to live off that for the rest of their lives. I mean, we can help those people too if they're already there, and that's what we were told to do. But if we just want to have our passive income exceed our ideal standard of living then we're financially free, right? And if I'm in my 30s, 40s, that's what I'm focusing on. By the way, we can show people how to do this in their 50s, 60s, and 70s too. Yeah. And I'm in my 50s, so when I say 30s and 40s, I just wish I knew about this when I was 30 years old.
Yeah, me too. Because it does, and it's also exempt from claims of creditors in most states.
Absolutely.
Not
most states,
every state, but in the big states, it certainly is. Certainly in Florida and in New York and Texas and probably California too, within certain constraints. Put it that way. We don't need to get into them. So, are there still a lot of companies that issue these policies?
Absolutely, there are companies all over the country. Some of the big New York-based companies and the Northeast-based companies, they do it. Some of the Midwestern companies, they do it. And what we look for is, depending on your age and your underwriting, your health, each of these companies kind of has their sweet spot for where their products work the best on those ages and underwriting class. We've done a lot of research to make sure that, and we can offer anybody. We're completely independent. So when we set up your insurance contract, we can do it with just about anyone. But we know what are the best fits are based on age, underwriting, and those kinds of things.
Yeah, gotcha. So interesting. So that's just one of the techniques that you have available? Absolutely.
And then what we do is once you build up this money pool, opportunities find cash. Would you agree with that, Carrie? Over your lifetime? And so when you have this money pool, it's almost like everything will line up and you'll have an opportunity that comes along. And I had a guy a couple weeks ago on our podcast who owns 40 mobile home parks.
Right.
Now, you mentioned Florida, and I live in Florida part of the year. I love Florida. My wife's from Naples, Florida. If you had a mobile home park in Florida, 90% of them, what do you think the average age of the person that's living in the mobile home park is?
I've never really considered it, but I'm not really sure.
It's over 70.
Really?
Now, do you think that they're going to be tearing up those mobile home parks? No. There's not going to be violence. There's not going to be, that's why I like Florida mobile home parks, because of that, and storage units.
Yeah.
Now, if you know the economics of mobile home parks and storage units, they're great. In storage units, you don't have tenants. So water, rodents, tenants, the things that cause you problems in real estate, you don't have those problems with storage units.
That's true.
And Florida is another great place for storage units because there's so many snowbirds, and they want to be able to store their stuff, rent their place out to offset the cost, et cetera.
Right. Gotcha. Interesting. So a lot of opportunities available, limited only by your knowledge and your imagination, right?
Absolutely. That's what we say, Kerry, is it's all about how you think, and then it's a participatory sport, meaning this isn't just give somebody your money, sit back and hope that they make you money.
Yep. Gotcha. So it's very active.
Very active. Yep. But you can hire professionals to do everything. I tell a funny story, Kerry, that when we needed toilet seats replaced at our house, my wife wanted to call the plumber. So that tells you the amount of confidence she has in my handyman skills, right?
Yeah.
Well, I own real estate that I've never seen, that I've never fixed the toilet, that I've never done any of those things because I have great property managers. And for 8 to 10% or less, if you have a large portfolio, you can have somebody do all of that, and you just get a check every month.
Well, there's nothing wrong with that.
Cool.
There's nothing wrong with that one. So
absolutely.
All right. So how did you learn all this, by the way?
So I spent the first 15 years of my career being a full-service financial planner from 22 to 37, and I met a man, Nelson Nash, who just passed away literally last week, and he was a mentor of mine and talked to me about Austrian economics and banking and how we have to control the banking function in our lives. And I read every book that I could get my hands on the subject, and I shifted. What I realized, too, is we had $700 million under management in our financial planning firm, and our average rate of return was over 9%, average rate of return, but the net return was closer to 4, a little bit less than 4. Because of taxes, fees, everything else, right? And the downturns in the market. Well, there had to be a better way. Right. And I started to study wealth, and I started to study people that had become wealthy in a relatively short period of time. And what I found is that they all did one thing, is they got money to flow to them instead of away from them. Sounds simple.
Very simple.
But Einstein said simplicity is elusive, right?
Yes.
So that's what I started to study. That's how I started to study this, became an advocate. I've studied everything. I put it to work. I bought 9 companies using this concept. And I bought a lot of real estate and everything. And I want to buy some mobile home parks now. So I not only talk about it, but I actually do it. And I can counsel the people that we talk to how to do it.
Okay. Interesting. So, Jim, just tell us how we find out more about you, how we learn your techniques, how we connect with you.
Absolutely. If you go to createtailwind.com, you can schedule just a quick meeting to find out a little bit more, ask questions, see an overview webinar, all those kinds of things. Or you could go to Breakaway Wealth on your podcast subscribing service and search for our podcast, or you could just email me, jimoliver@createtailwind.com.
All right. And as always, we'll have a link in the show notes to your site. Jim, any questions or comments for either of us, email me, kl@kerrylutz.com, Twitter feed @KerryLutz, Facebook page, Financial Survival Network, Whether you're on a podcast or YouTube listening to this interview, please subscribe, whatever platform you're on, like it and share it with others so we can get information, valuable information like Jim is providing you with to everybody out there. It's so important because, there's this dearth of financial education in America. There's a real problem with financial knowledge, and we want to get the word out far and wide that alternatives exist and that all you have to do is know who to ask. And once you've got that, once you've got the knowledge, you're halfway there. Hey, Jim, it's great having you on. Appreciate it. We'll definitely have you on again. Good luck.
All right. Thank you, Kerry. Thanks for your time.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.